One overrated investing thought or investing idea according to you?
Yeah, I'll have to say short-termism. I see this a lot. People are always at cocktail parties or social events, especially in India. I feel asking about what is a interesting, sexy investment that you made, and people are kind of talking about the ones that have done really well in a short period of time. But I really feel that for us as family offices to be long-term investors, we need to have a much, much longer time horizon. And so I don't like the ones that are just, too good to be true. A little too sexy is always makes me a little cautious.
How do you decide when it's not just money at stake, but family's legacy and reputation as well? If you want to know how India's wealth custodians think, this is where you'll find it. Welcome to our new podcast series, Inside the Family Office, where we speak with leaders who navigate this change every day. From managing generational wealth to balancing trust, tradition, and legacy, we go deep into what it really takes to run a family office. He's seen the full spectrum from managing money for one of the largest pension funds globally to managing money for hugely respected family office in the country. Our guest today is Mr. Vikram Desai. So Vikram, you've always been very elusive and you maintain quite a low profile. But I know you have decades of experience. How many years is that?
I've been at this for a long time. I've been doing this for about 26 years now.
Yeah. So why don't you just take us very quickly through your professional journey
Sure.
for the benefit of our audience?
No, absolutely. I mean, I started my career actually in the US doing investment banking. I did mergers and acquisitions in technology in Silicon Valley in the late 90s and early 2000s, which was a remarkable time to be there. Learned a lot and then ended up working in private equity in San Francisco for a few years doing very traditional investing. And then I had a very transformational early career experience where I was brought on board by a very high profile family in Boston to actually manage their family office. So this was early 2000s. I was essentially given a Bloomberg machine and told, don't lose any money. But I had a lot of freedom and flexibility to really learn the craft of investing, both self-taught as well as from many, many other experienced practitioners in the field, because we had the ability to go and talk to a broad range of people. And managed money for these two families, one in Bangalore and one in Boston, for about a decade before I moved back to India, which is where I was very keen to return home. And ended up managing money and advising the Canada Pension Plan, the CPPIB, on their India business and their office, which I did for about 5 to 6 years before I joined our family office. I think it's a real privilege, to invest long-term capital. It's something that I've learned over the years and I enjoy tremendously. I think we have so many benefits. We have really multi-generational capital to manage, which means that I don't have to make decisions for the next one quarter, but I can look out 25 years, right? Or more, exactly,
Yes.
and hopefully many more. And think about the impact of my decisions longer term. And I find that part of the job and role very fulfilling. You get a chance to work with really some of the best investors in the world, with some of the best families in the world and peers. So it's been a great journey for me, and I think it's a real privilege, I think, for our community, the family office community, to manage long-term multi-generational capital, and I truly view it as a privilege to be able to manage this money.
So Vikram, you mentioned about coming to India. Now take us back, because I've heard it from you before. Take us back to how Hemendra Kothari, the patriarch of Kothari family, got you into managing DSP family money. I know there's a little bit of a story there.
Yeah, well, look, when I got married into the family, I, did not foresee or want or expect that I would sort of become part of the family group. I think there are some benefits to, having that separation. But at some point, a lot of what I was doing, the way that Hemendra and I discussed was that I was really utilizing a lot of my capabilities and old experiences and networks and relationships to really benefit maybe a group of investors that you probably wouldn't even ever see. And I think there's something very fulfilling about actually managing capital for people that you see every day, right? And I think it made sense to kind of bring it home a little bit. And so that was my journey back into the family office.
And when you think about the early part of your career, was there a mentor or someone specific you can think of who really helped you learn or shape up your ideas, beliefs, thought process?
Yeah, wow, Yamini, what a great question. I think I've been incredibly fortunate and privileged to have incredible mentors professionally. There are so many folks. I can take names. Spencer Fleischer at Friedman Fleischer and Lowe at the San Francisco private equity firm I was. Desh Deshpande, who is one of the most brilliant human beings that I've worked with in the past, whose money I had the privilege of managing in Boston. Um, Vikram Gandhi, who I worked with to come back and help the Canadians set up in India. So I think over the years I've been very fortunate to have incredible mentors who've taught me a lot, who've given me a lot of room to learn and to grow and to invest and to experience. But then I think, of course, Hemendra Bhai for me is a very, very special relationship and mentor in my life.
Okay, now let's get into the heart of family office investing. Can you explain to our viewers what kind of decision making models you like to follow, and especially in context of Kothari family office?
Sure.
We know that there are a lot of centralized leadership decision makings or sometimes investment committees. There are different ways families end up taking decisions. So what are your thoughts on the same, Vikram?
Sure. No, Yami, such a great question. Look, maybe I can start a little bit with my experience at the pension plan, and I think the way that pension plans invest capital and deploy money is truly, it's truly incredible because they apply a high amount of rigor into the process. As you know, they have many different product groups: private equity, private credit, public equity, etc. And each of these groups are essentially competing for capital, right? And there's a very high bar because they're investing on behalf of the pensioner, so they're acting in a fiduciary responsibility. And so all these different groups are competing for capital, and they have to rigorously document their process. They have to explain why the pensioner should be investing in a public equity asset as opposed to a private equity or infrastructure asset. And all these different investment committees essentially fight for capital and compete for capital, and the best, most compelling argument wins. I think it's an incredible way to invest, which is that you're always checking to make sure that wherever you're deploying capital is the best place that you can put that money to work. So those are the advantages of the process. I would say the disadvantage is that it actually creates a lot of bureaucracy. It creates a lot of investment memos being written and documented, and somewhere I feel that the family office space, you kind of have this incredible ability to use the quality of judgment and experience. So for example, at our family, the relationships that we've had in the industry or with the different promoter groups, literally over many generations, give us a very, very good understanding of how certain business groups may behave or how certain investments may behave under different scenarios and circumstances. And so part of my role is to marry that judgment, which is kind of resident in the family, with a very high degree of rigor, right? And really come to the best investment decision for the family.
Can bring in a lot of agility in decision making.
Exactly. So, whereas at a large institution, you may get stuck in some of the bureaucratic processes. Over here, you have the ability to act with, I would say, very, very good, not perfect information, but most people around the table who are in decision-making seats, me and other family members, are very aligned and have very, very good information. Whereas at a large foreign institution, a lot of time is spent educating. People are writing investment memos about India and they've never even been to India. So you are starting with a very different sort of knowledge and experience level. So my job really as kind of the head of the family office is to bring together rigor into our investment process. So it's not just some family member waking up and saying, "Aaj gold karna hai, aaj ye bechna hai," etc. But to combine that rigor with all the benefits that we have of judgment and experience.
So can you share some example with us where this governance really helped you in terms of avoiding a bad decision or making a good decision?
No, it's a great question. I think, sometimes what happens in some of these foreign large institutions or even domestic large institutions is that people I'll give you an example, they use valuation, right, as a reason to invest or not to invest. And in India, for example, many excellent companies that have delivered great returns over long periods of time trade at very high valuations. So if you are completely process driven, for example, you will only use valuation as a screen and you will exclude some excellent companies. Whereas a domestic family office may say, look, I know that promoter, I have known that family for 3 generations. I understand why they trade at such a high multiple, and I can assess that the business is going to continue to grow at a very high rate. And so you would make that investment in a high valuation company even though the optical measures of it may exclude it from other people's portfolios. Similarly, in India, what sometimes tends to happen is that Companies have, especially in the public markets I'm primarily referring to, but companies can sometimes put up very good numbers, but there may be some serious doubts about promoter quality. And so they get included in, let's say, a lot of people's portfolios, but you know, we are
They get included in people's portfolios also through party conversations.
yes, exactly.
I think, how do you avoid that noise as well, because
Yeah.
all of you
Yeah.
in the family are well connected, and there is this huge level of information or slash noise
Yes.
which comes your way. So does the structure help you avoid that, deflect that?
Yamini, this is the way I address the problem at our family office. Or problem, I wouldn't say problem, the issue at our family office is really come up with some very disciplined guardrails around asset allocation.
Okay.
This is this much in public equity, this much in private equity, this much in gold, this much in different asset classes based on where we want to be, let's say, a generation from today or 2 generations from today. And we keep modifying those. Once those guardrails are in place, right, anyone who wants to change or make a very meaningful change has to present a pretty robust argument as to why they should be doing it. And so I think there are some things we can do, right, that create some very natural measures to actually protect our investment portfolio and our risk return allocation.
So basically, you have in place that this should be my public market exposure and this should be private. Is that how it works?
Correct.
Okay.
Yes.
And
we broadly set those
for
guidelines.
all different asset classes.
Exactly. Exactly.
Okay.
So mutual funds should be this much, or fixed income this should be this much. I mean, given currently what's going on, relevant topic is the US dollar and its depreciation. Will that significantly change over the next decade or 2 decades? Should we as a family be making any meaningful shifts in our overall portfolio asset allocation to capture a range of views and a range of potential outcomes? So those are the types of decisions that we're really focused on. I think that cuts out a lot of the noise.
So Vikram, risk preference, risk appetite can be very different across generations. So for example, if we talk about Kothari family, Hemendra Bhai, we know, has been a fanatic of public markets. He loves public markets, and he loves liquidity.
Loves liquidity, yes.
And from the time you've kind of come in, you've also added a layer of private investments. And we all know that private investments bring in a dimension of illiquidity to the overall portfolio, less transparency. So my question to you is, how do you see this evolving, or how do you maintain a cohesiveness across decades when it comes to families' thought process and when you see this thought process evolving?
Right, right. No, Yamini, I think the way I approach this kind of complex intellectual problem is, how do I think about risk-adjusted return? And given that we have a long investment horizon, we have multi-generational capital, what are the kind of arbitrages available in the market if I'm willing to reduce my liquidity requirement a little bit? Because we don't require that kind of liquidity all in T+2 or within 2 days. And so a lot of my role is to think about the risk that is currently in the portfolio and how do I generate the best risk-adjusted return multi-generationally. And that exercise threw up some very interesting answers. One of them, of course, like you correctly alluded to, was increasing some of our private equity exposure, which frankly has been, I would say from a return standpoint, quite challenged. And the other sort of big thing that I did to reduce overall risk in the portfolio was to add gold. So, what my role has been is to take essentially a very public markets heavy, liquidity heavy portfolio and start to create small little sections of illiquidity, whether using gold or international mutual funds or private equity, to kind of dampen the volatility in the overall portfolio.
So Vikram, you made very interesting statements there. I'll take you back to your earlier statement. You said private investing has been challenged. So do you want to talk a little more about it?
Sure. I think, look, when you lock up money for longer periods of time, Yamini, essentially what you do is you expect a higher rate of return from those investments, right? And so said another way, the return expectation for private equity assets is higher than our public market assets because we're...
No, let me add.
Sure.
Sorry to cut you, but let me add here. I feel that, the general perception is a lot of unlocking of value has moved from public markets to private markets, especially so in the last decade, which is partially true as well.
Yes.
And hence, the private participation is something which has really accelerated by families.
Mm-hmm.
So, having said that, you mentioned that it is still challenged because so how do you kind of look at it? How do
Yeah.
you evaluate when you are looking
Look,
at
I
it?
think the right answer is you control risk through sizing, right, of asset classes. So let's say if this asset class, Indian private equity, was generating 25% plus IRRs, we would add more to that allocation, right, because that would essentially decrease our risk return. But if it's not delivering, then we won't increase as much. And so I think we utilize sizing around different asset classes as a risk control measure. And our private equity exposure today is sub 10% overall in the portfolio. But the real winner has been gold for us. I think that's one that we had a small position, going into COVID. We added over the years. We've recently added silver, and so I think again, Yami, let me address this question with an intellectual construct, which is that the problem that I'm trying to solve for is to maximize my risk-adjusted return multi-generationally, right? And the way I do that is I don't have massive exposure to any single asset class. I diversify my risk. Diversification is the only free lunch available in finance. And I diversify that across different asset classes, having the best information possible at a given point in time.
You touched upon gold, and in fact, Vikram, you've been extremely vocal about gold in the last few years. Even in different DSP family office forums. How would you advise families to look at it? As just an inflation hedge or a driver of return, or just to have it in the portfolio as a, like a marginal allocation? How
Sure.
do you look at gold?
Sure. Yamini, on this one, I have an interesting story. Just last week, one of our younger family members sent me an article saying that Warren Buffett thinks gold is a terrible investment and has no economic value and has no
Yeah.
interest component, etc. And so why do we have so much of it?
Doesn't have cash flows.
And doesn't have cash flows, exactly. And so why do we have gold and what are the reasons? And I think it's a great question. I think the issue is that we're Indian domiciled investors, who have access to investments mostly in rupees. And so if I was Warren Buffett and I was sitting in the US and I had, a very large liquid ecosystem to invest into, a very mature ecosystem, maybe I may not choose gold. But as Indian investors, and our audience today is Indian family offices, I think gold has this remarkable role to play in our portfolios, which essentially gives us exposure to real wealth, right? And so the question that people ask is, are you measuring your wealth in dollars or in rupees? Right? And I mean, the right answer to that is you have to measure wealth in the currency that you're spending in, right? So that's the correct answer. But the truth is, what gold does is it basically massively enhances our risk-adjusted returns because it creates a hedge, it creates a dollar peg. It's an inflation-linked investment. So there are many positive impacts, and I think it's been a great success story for us.
And
frankly.
in the last few years, central banks have accelerated their gold buying as well.
Exactly. Yes. No, all the trends seem to point towards, more significant appreciation in gold prices. Obviously, it's a limited asset, limited in its supply, and so that has some interesting implications for returns and characteristics as an investment. But look, these things can change also. So I think again, for family offices that may be listening to this podcast or watching us, I think the important thing is sizing. Right? You don't want to, just because gold is great, you don't want 50% either, right? So you have
Sure.
to think about what is your overall portfolio, what is your overall risk-adjusted return, what is the right amount of gold for you. For us, it's roughly in the 10% range, which is high, but we think that gives us a really nice kind of hedge at this point in time for our overall asset allocation and risk-adjusted return. Others may choose, much lower numbers, and that's fine too.
And there is no ideal range according to you.
And there is no ideal range, exactly.
So Vikram, we've emphasized enough how we're managing multi-generational wealth. And one question that everybody does ask is when to buy. I want to ask you the opposite. When to sell? And is there even a good time ever to sell?
Yeah, Yamini, I think that we've broadly set some asset allocation targets for different assets in our portfolio. And I think we have actually lived through a very interesting time in the last 5 years, which is that almost everything has gone up. So ideally what should happen, let's say in a portfolio where I'm building a negative correlation asset like a gold, which in the past when equity markets have gone up, gold has actually come down and vice versa. Those are what the historical correlations show. So if that was what was happening, then I would be rebalancing my overall asset allocation percentages to stay at the targets that I've set largely. What's interestingly happened in the last 5 years is these asset classes have moved in tandem.
Yes.
So I haven't really had a position where my numbers are actually still very equally balanced. So I'm not rebalancing or selling on a frequent interval. Ideally, family office and long-term multi-generational investors have long time horizons. So they don't want to be sellers during periods of duress or stress or crisis. They want to be buyers and providers of liquidity during a time of stress. So, I think we will sell when we meet our asset allocation benchmarks. If we have one asset that just completely goes off
Out
what
of
our
whack.
overall target asset allocation, then yes, rebalancing is a very critical part of all portfolios
But
and certainly
what is
multi-generational.
frequency at which you recommend rebalancing?
Look, I personally don't advocate as taxable investors, exiting positions and then incurring tax and then having to find a way to reinvest. Even today, as I look out on the broad macroeconomic landscape in India and globally, it's difficult to find an asset class that is a screaming buy, for example.
Sure.
So even today, let's say if I liquidated my gold position, which has done very well, I'm going to incur some tax on it, and then where would I reinvest it, right? And that answer today is not clear to me. So I think this is a very careful and nuanced question. Certainly, if we came to an assessment that value was showing up in a specific area, we would rebalance out of our portfolio. But ideally, you want to hold these assets and let the compounding assets continue as long as possible.
A lot of family offices have this bias towards activity, which makes them sell or makes them churn their portfolios more than required. I mean, that's what the larger observation has been. What is your advice, Vikram, to all these newer families, and how do you think they should look at selling per se?
Look, it's been a bit of a challenge for me also. I think all family members have a instinct or desire to transact, right? I think it's a very natural and normal human and investor phenomenon. You're reading news flow, there are things that are constantly changing in the world. I think there is a huge bias towards action. But the family office world and sort of multi-generational investing world is really about letting the compounding play out. So to be very honest with you, Yamini, we actually haven't sold a lot of positions in the last, I guess now maybe 7 years that I've been here.
Wow.
We've been actually accumulating and slowly trying to build and strategically deploy capital in areas, right, that we think we can hold for long periods of time and experience the benefits of compounding. So we are not, very frequent sellers, I would say. Yes, of course, if a specific asset class ran up very specifically, then, let's say if gold all of a sudden went up 100% from here or something, I think we would definitely look at rebalancing our portfolio into more kind of balanced long-term outlook. But we are not, we try to stay away as far as possible from making transactional decisions. And I would guide other family offices also to think carefully about, sort of incurring activity for the sake of it, paying the tax, and then trying to find something else to do. It's not a great.
I remember talking to this one family office, and he was very clear that 90% of my portfolio is core, but 10% is something that even I need some activity. So he was very clear in his mind
Yeah.
that I am doing this for entertainment.
Yeah.
In fact, this is what Aditi calls it, entertainment capital. So be
Yeah.
very sure that this is your entertainment capital,
Yeah.
and
Yeah.
then it's okay to have
Yeah.
a robust activity on that part of your portfolio.
I think that's a really good way to do it. You carve out X percent, you say this is the money I'm going to play with.
Yeah.
And, but do I get the call right, the satisfaction of getting it right? Not probably, a lot of people don't admit it when they get it wrong. So you don't have to admit to anyone that you got it wrong. But yeah, I think that's a really good way to actually think about it.
Core satellite kind of an approach.
Yeah, absolutely.
Larger the core, better it is.
Yes, for sure. In general, I think less churn, less constant selling for the sake of selling. I mean, if you have good asset allocation targets and you're rebalancing, I think that's very legitimate and fair. But I think just to do things for the sake of doing them is something that I try to drive away from.
And I think the problem also happens when this satellite or this whatever, say assuming it's 10% of your portfolio, that becomes 20. That's when the illusion that, okay, I'm great.
Yes.
And hey, this is doing well. What my other part of my portfolio is only giving me 15% CAGR, and this is doing 30% or 40%. That's when the temptation to avoid the temptation of activity is something which is very critical.
Yeah, Yamini, you're so right. I see this all the time. Look, the idea is that not everything in our portfolio should be going up at the same time.
Yeah.
Right? And so that's a very counterintuitive kind of facet of our investing as a profession, right? Which is that when you have a broadly diversified portfolio like most families do or should have, when everything starts to go up or something is starting to do exceptionally well, oftentimes that's when you need to start pruning, right? As opposed to dedicating more resources there. And I think that, I think the families that have that discipline, right, are very fortunate. I think a lot of the newer family offices who have core operating businesses in non-financial businesses, right, for them this feels like a bit of a casino or an entertainment or a game, right? And so you kind of tend to poo-poo your returns that you're making in your core operating business because you're generating so much more in the stock market. But I think there's lots of empirical data that shows that that's not really sustainable at a scalable level. And long-term sound principles of asset allocation and investing are really the way to compound wealth over a long period of time.
Since you spoke about operating businesses, I wanted to bring out this nuance as well. The fact that DSP has a core operating business. We have a profitable asset management business which throws cash every year. And now that's very different from a family office which has had a one-time liquidity and today is just managing wealth. So does predictable cash flow increase your appetite for risk, increase your appetite for volatility? How should a family which has an underlying operating business look at managing wealth versus a family which has which is sitting on a liquidity event and is already managing just wealth and there is no other operating business to fall back upon? What would be the guardrails that you would suggest that families should follow in both cases?
Sure. Look, I view this problem through the lens of risk. So when I look at our overall exposures, right? I mean, what are the exposures that the DSP family is most exposed to? We're very long India, and and that's for a reason. We truly believe that India will be a very important story in my investment lifetime and multi-generationally as well. And so that it reflects that view, right? That we're long India, our core assets are equity assets. But the way I think about it is that I'm trying to build a family office portfolio to offset some of the risks that may be present in my operating business. So, I'm constantly approaching this from the lens of risk. And so that's how I would recommend other family offices look at it as well.
In fact, here is where we should also talk about, investing when you have an operating business. And if I have to here talk about Aditi, we know that she is investing in a lot of businesses which are in a way peripheral to what our core activity is,
Indeed.
which is asset management, which means again sticking to core competency, investing in things that we understand. So
Exactly.
is that something you'd like to talk about and how should one look at?
Yeah, I think that's a very important thing is to, again, I'll take it back to risk and let's change the lens a little bit, Yamini. So let's say if you are a business that's focused on, let's say your core product is a consumer product or it's a consumer oil product or a coconut oil product or something. I think the job of the family office is to sit down and look at all the risks that the family is inherently exposed to. What are the long-term goals that you're trying to achieve? So you want the right mix of compounding something that's doing well and then saying that, look, I also need to create a counterweight and a counterbalance. And I think the answer the DSP family has come up with is that if we do make private investments, our first preference isn't something that's related to financial services. That's an area that we know well. That's an area that we can understand unit economics. We can understand management depth and talent capabilities that exist in the marketplace. And how do we utilize our inherent competitive advantages and our strengths and invest in a way that is consistent with those strengths as opposed to trying to do something completely different. And I
Isn't
that
it
seems to
also
work.
giving back with a purpose to entrepreneurs? And obviously, the idea is also to make money at the end of it. But it's a form of
Yeah.
impact investing, is it? Is it how you look at it?
Look, this debate is unresolved, Yamini. I would say, we have an important role in the Indian ecosystem to encourage entrepreneurship. But at the end of the day, as I sometimes explain, is that we have a charitable trust from which we do charity. And I think the goal is commercial primarily. So I think it's a complicated question. I think in India or really globally, we do have a very important role to play in the ecosystem, but I would say our first lens is a commercial lens when we invest in new ventures.
So, Vikram, how do you manage portfolio return expectations? A lot of families, and especially newer families, struggle with what should be their targeted rate of return. So, how would you want to break that down? Can you give us a framework around return expectations, what it's been and what it should be going forward?
Of course, I mean, so what we do is we look at every single asset class. So equity, fixed income, private equity, commodities slash gold slash silver. And what I do is I assign sort of an expected rate of return to that line item. I do that looking at historical correlations, a lot of data that we have access to, and a volatility range. And essentially what I do is I then look at what my current portfolio is. So let's say I'm at 40% equity, about 25 to 30% fixed income, 10% gold, etc. And I basically weight my averages for each of those line items to come up with an expected return for my portfolio. And I think it's a very critical exercise that I think a lot of new family offices should definitely do, because it helps to temper and kind of come to a very realistic set of expectations as to what your portfolio will do. I have engaged in many of these discussions with lots of sophisticated investors in India and globally as to what a long-term rate of return should be for an Indian investor at scale. And I think we've come to a conclusion of roughly 12 to 14% nominal Indian rupee returns, without going into too much detail as to what your underlying equity allocation is, but really maybe at a 40 to 50% equity allocation, is a good long-term target for our nominal return, and that hasn't really changed much over the last, I would say the last decade or so.
Also, return, isn't it a function of inflation? I mean, the first decade, if you just go back to 2000, 2010, we've seen on an average a higher inflation versus what we're seeing right now, and what is the expected inflation in India. So, if you want to also talk about that as to how you have to look at the growth expectations of a particular economy and inflation, add inflation to it, and or just about equity risk premiums. What are the equity risk premiums that a market like India is deserves right now, and then how do you look at sovereign yields and equity risk premiums? Do you want to talk about that as well?
I could. I think I'll make one important point there, Yamini, which is that it's changed significantly in the last decade as India has grown. And so essentially the equity risk premium has reduced, the cost of capital has reduced, the cost to hedge for foreigners in the Indian rupee has reduced, so our currency has become significantly stronger. And so I think when we look forward, we try to model in those expectations. But again, I'll stress that there's no right answer. So a lot of our investment art, and it's not all a science, as you know, is assigning probabilities to certain outcomes. Right? And in my mind, when I'm looking at let's say an Excel sheet that says expected return from equity should be 13%, what I'm also doing in the background is assigning a certain probability, right, to the probability of each particular outcome around inflation or equity risk premium or equity returns, and then trying to construct a portfolio that best captures that. And to be quite honest, it's not a perfect science. So, these things change over time. There are adjustments that happen. Facts change, geopolitics change.
Investing is probabilistic.
Investing is probabilistic. Just the craft of investing is a highly probabilistic sort of profession and craft. So it's
There
not
is
exact
that popular
science.
quote, like you just mentioned, when facts change, I change my opinion. What do you do, sir?
Yeah, exactly. Well said. So I think it's really, it's really about 12 to 14% nominal INR returns at very reasonable level of risk. I think is a good long-term return target.
Vikram, Kothari family has been in business for more than 160 years. What, according to you, is that one principle that you think shall be relevant even 50 years from now? Markets may change, business models may change, but what is that one principle you think which is extremely relevant for Kothari family office?
Sure. Yeah. I think integrity for us is above all. You've known Hemendra also now for a long time, and I think it sits on our shoulders in our generation to carry forward his exceptional track record of integrity that I think really pervades through the entire group, the asset management business, our family office. We want to do right by our beneficiaries, by our stakeholders, by our investors. It's not always easy. There are tough decisions that sometimes need to be made. There are commercial gains that need to be sacrificed. But I would confidently say that for us, the leading light and sort of value is integrity. I think we all try to take it from Hemendra and then practice it in our daily lives as well. So it's really allowed, I think, the group to go through a lot of ups and downs over the many, many decades that we've been in business, and I'm sure many more that we will continue to be.
Every time we talk to him, he says, "Kuch bhi karna, mera naam kharab mat karna."
Yeah.
So reputation is of utmost importance to us, and I think
Yes.
that's what something we even try to bring the way we build products and the way we recommend products or talk about products to our investors as well. So yeah, I think I completely understand that. I live it every day, and in fact, just like an add-on question on those lines. So philanthropy, how does philanthropy fit in for the Kothari family? I mean, some of us know that Kothari family is big time into wildlife conservation trust. Do you want to talk about that, Vikram?
Sure. Look, I think philanthropy is a deeply personal thing, and I think we don't speak about it too much. But as you know, every family member has been philanthropic, I think, for many generations in their own personal capacity. But Hemendra personally is one of the largest benefactors of wildlife conservation in India. In his private capacity, as family members, we all love going to safaris and the amazing biodiversity that India has to offer and experiencing that together as a family now with my niece and nephew, the youngest generation as well. I think we have a principle of kind of utilizing family resources to kind of do good. It's a very critical framework of, I think, how we think as a family and something that's very close to all of our hearts.
So, Vikram, you've given me all the right answers. Now, I'm going to ask you, how do you handle being wrong, both in investing and in life?
I think the principle that served me well, honestly, Amini, is honesty. You own up to your mistakes as quickly as possible. You share that with your family or your stakeholders if you've made a wrong call or a bad hiring decision or what have you. But honesty seems to have worked pretty well for me so far.
On the same lines, what is it? What are those governance mistakes that you've seen other family offices do that you've consciously avoided?
So I think every family office has a interesting decision-making process. There is usually a patriarch who is highly experienced and has very strong views. And then there are usually other family members or investment committee members or professionals who also have very strong views. I think the challenge really is to bring the best knowledge and experience possible to then make the best investment decision for the family. And that can be very complicated and challenging sometimes.
How does one get this knowledge? Like, how does, so
Yeah.
do you like recommend having a, see, generally we've seen families operate with one trusted person that they have who's been with the family for long, helping also with, decision making when it comes
Right.
to investments. But do you really recommend getting in professional help? Do you recommend, if one doesn't have time beyond operating business, to leave it to professional managers? What would your approach be?
Yeah, I mean, every family comes up with its own approach. I think obviously trust is a very critical component of this, which is why you see sometimes many people who've been around for 20, 25 years, maybe in an operating role, all of a sudden are making investment decisions. And so there's a mismatch in terms of skills versus trust levels. And there really is no right answer. You have to eventually be comfortable. You're managing essentially your private assets. And so you need to have a high degree of trust in whoever is doing it. I think the ones who have done it well, and I think there are a few of them, find that magical combination of promoter slash patriarch giving his best views, drawing from the best experiences, marrying it with rigorous analysis, marrying it with someone who's skilled as an investment committee member, maybe a family member has that skill set.
Or you build that skill set over time.
Or you build that skill set over time, and also having an external investment committee member. Many family groups utilize 3 to 4 very senior advisors that they bounce more complicated issues off, not just investing, but succession planning and governance. And so I think it's a very dynamic space. There's a very interesting saying that I'll end on, which is that, some people say that every family is different, but every family is the same. And there's a flip side, and some people say every family is the same, but every family is different. And I think, every time I think about those statements, I think there's an element of truth to it, that there are many common issues, but everyone comes up with their own approach in terms of how to handle complicated issues.
I do believe that personal finance is truly personal. But the thing is, when you're talking about a family offices, there are subsets of personal preferences, which makes it far
Yes.
more complicated.
Yes, indeed. Yeah.
special segment, virally fast with Vikram Desai. So I'm going to
Okay.
shoot a few questions at you,
Sure.
and very quickly I'll expect some answers from you.
Okay.
So
But I
what
may
is
give you long answers,
Yeah.
but I'll give them too quickly.
That's all
Okay.
right. What is that one investment idea or product which you'll never allow in Kothari family's portfolio?
Yeah, it's a good question. Yeah, I mean, these days the world has become so focused on social media. And the other day, one family member sent me a message saying that someone was raising a viral fund on Twitter. And they were asking about capital coming in, some interesting person who had set up something. And I don't think we will ever invest in a fund that's raised on Twitter or any other social media form. So,
Great. What is more riskier, crypto or a family dinner debate?
okay, that's a good question. Well, both are pretty risky, but I would have to say that crypto is definitely riskier. And it's not something that I think we would do. But the family debates, I think we obviously have very healthy and interesting debates, and people
Manageable.
have strong opinions. Well, not always manageable, but I think eventually we come around to reconciliation and a recognition that we're all aligned and are basically working towards the same common goal. So I would say crypto is definitely riskier.
Okay. One overrated investing thought or investing idea according to you?
Yeah, I'll have to say short-termism. I see this a lot. People are always at cocktail parties or social events, especially in India. I feel asking about what is a interesting, sexy investment that you made, and people are kind of talking about the ones that have done really well in a short period of time. But I really feel that for us as family offices to be long-term investors, we need to have a much, much longer time horizon. And so I don't like the ones that are just, too good to be true. A little too sexy is always makes me a little cautious. So that's
Abhi
kind of
kya
stay
acha
away.
lag raha hai?
Yeah, exactly.
Right.
Try to steer clear from that thinking.
One underrated investing hack or a underrated investing principle that you think doesn't get the kind of attention it deserves?
Yeah, I think, listen, Yamini, related to my prior point, it's really about longer term, right? I mean, at family offices, we're very privileged to have multi-generational capital. And so the choices that we make today actually have far-reaching implications over 50, 100 years. And this is also what I learned in my prior professional background, at a large pension plan and also at a family office in the US. So I would say really thinking about investments as a family office with a long-term time horizon is just very, very critical. And I think that's overrated. Like I said, people get too caught up in the short-termism of things.
So one underrated investing hack / principle which you think does not get the importance?
Yeah. Look, I mean, the impact of taxes, Yamini, in investing is just very, very understated. And I think there's so much of short-termism these days that people want to churn their portfolios constantly, and they're incurring a tax leakage. And when you compound that multi-generationally over many, many years, 50, 100 years, there's a very meaningful impact. And so I think people really underestimate the impact of taxes on their short-term investment choices. And I think we as an industry and we as family office investors have a lot to do to talk to our peers around educating them that while you may be trying to capture some short-term gain, it's really tax inefficient in the long term.
Also the fact that when you have maturing products and you get
Right.
that return of capital as well,
Yes, exactly.
and again that leads to certain amount of tax incidence.
For sure.
So can we avoid that, and can we have more perpetual products?
Exactly. No, I that's a great point. Yeah, I mean, I think when people think about even private equity returns, they benchmark them to public markets. They look at it kind of on a pre-tax, pre-fee basis very often, but really the right way to compare it to a public market product is to look at it net of taxes. And I think as the family office and the investment landscape in India evolves, you'll see a lot more maturity around some of these short-term investment decisions.
Okay. Vikram, family offices often talk about patient capital. You've also spoken about it, but tell me really, how patient are you when market falls by 20%?
Yeah. Listen, Yami, I'll tell you a great story. When I came on board at DSP Family Office, one of my first kind of tasks was to write a family investment statement. Essentially it's called investment policy
Yes,
statement or an
IPS.
IPS. And, we drafted this very extensive one. We tried to keep it simple and brief, but it was quite extensive, saying that if there was a big market dislocation, 20% or more, we would add, meaningfully into our equity positions. And of course, this was maybe about 6 months before COVID, and then COVID happened. And, markets just kept tanking.
Yes.
And it was obviously a very stressful time for all of us personally and professionally and as investors. And I remember being in an office with 3 or 4 of our sort of key senior people in the room saying, like, look, the market's down 20% today. Who has the guts to add? And I mean, it was really astonishing, given our discipline as investors, our training, the fact that we had codified it in a document, I don't think still anyone really demonstrated that conviction to act at that point in time. We did, of course, over time as things started to change. But I think that's the very interesting thing that I wanted to highlight about family offices is that, we have a very high degree of discretion, a tremendous ability to exercise our judgment. But these things are really tough, I think eventually we were able to get there.
It needs a lot of courage at that moment.
Correct. It needs a lot of courage
conviction.
and conviction at that point in time. And, I think there are ways to address it. But in some sense, I think having an IPS is a very healthy and important experience and requirement for family offices. But the actual implementation of it can be a little difficult. And I think it does require a high degree of judgment and revisiting some of those preset boundaries and coming back to it at a time of crisis.
Vikram, this was such a thoughtful conversation. Thank you so much for your time, and I'm sure a lot of newer and emerging family offices will benefit a lot from your insights on decision making, investment frameworks. Thank you so much.
No, my pleasure, Yamini. Thank you for having me, and thank you so much for all that you do for DSP. We're now in your 15th year. Very fortunate to have you, and the relationship that you have with this new and emerging segment, I think is very exciting that for us that you are covering it. So thanks again, and happy to do this again in the future if you'd like to.
Thank you so much, Vikram.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.